Here's a truth that almost nobody will admit in polite conversation. Most people are scared of investing. Not a little uncomfortable. Not mildly hesitant. Genuinely scared. Scared of losing money. Scared of making the wrong choice. Scared of not understanding it well enough. Scared of the market crashing right after they start. And because that fear feels so legitimate, so reasonable, millions of people sit on the sidelines for years. Sometimes for their entire working lives. Watching their savings account balance grow while their actual wealth stays flat. And the whole time, inflation is running in the background. And the stock market is compounding for everyone who showed up. And the gap between the people who invested and the people who didn't keeps getting wider. Fear has a price tag. And for most people, that price tag is enormous. Today we're talking about why investing feels so terrifying. Why that fear makes total sense but shouldn't stop you. And exactly what a first step looks like. For real people with real concerns, starting from a real beginner level. Let's start with the fear itself. Because dismissing it doesn't help anyone. Fear number 1, losing everything. This is the big one. Every person who's hesitant to invest has some version of a story in their head. They saw the 2008 financial crisis on the news. Or they remember their parents talking about losing money in the dot-com crash. Or they know someone who lost money in a bad investment. And the brain files all of that under investing is dangerous. Here's the context that story is missing. Yes, markets crash. Yes, individual stocks can go to zero. Yes, timing can be brutal in the short term. But broad, diversified, long-term investing in the overall stock market has never permanently lost money for someone who stayed invested over a long enough period. Every single major crash in American stock market history, 1929, 1987, 2000, 2008, 2020, was eventually followed by a full recovery and new all-time highs. Every one. The people who lost permanently weren't the ones who stayed invested in diversified funds. They were the ones who panicked and sold at the bottom. Or the ones who were in individual stocks that collapsed. Or the ones who were over-leveraged and got wiped out. Boring, diversified, long-term investing in index funds has an extraordinary track record. Not because the market never goes down, but because over long periods it goes up more than it goes down. Fear number 2, not knowing enough to start. This one keeps more people out than almost anything else. People feel like they need to understand everything before they can do anything. How to analyze stocks. What PE ratios mean. How to read earnings reports. When to buy and when to sell. And they keep researching. Keep reading. Keep watching videos. But never actually start. Because there's always more to learn. Here's the thing though. The average person doesn't need to know any of that. Seriously. The most effective investing strategy for most people is also the simplest one. Pick a low-cost index fund that tracks the overall stock market. Invest consistently. Don't panic when it drops. Leave it alone. That's it. You don't need to analyze earnings reports. You don't need to understand options trading. You don't need a Bloomberg terminal or a finance degree. Index fund. Consistent contributions. Long time horizon. Done. The complexity is optional and for most people counterproductive. Studies consistently show that the average actively managed fund underperforms the simple index fund over long time periods. This sophisticated approach, trying to pick winners, time the market, trade, frequently produces worse results for most people than just buying and holding a simple index fund. So the knowledge barrier people think they need to clear before starting? It doesn't exist. Not for basic long-term investing. You can start today knowing almost nothing as long as you're buying diversified funds and leaving them alone. Fear number 3, bad timing. This one is brutal because it's so persistent. The market feels too high. Then there's economic uncertainty. Then an election. Then inflation news. Then a recession warning. There is always a reason to wait. Always. The problem is there has never been a perfect time to start investing. Not once in market history. There has always been uncertainty. There has always been something scary on the horizon. And yet the market has trended upward over time despite every single one of those concerns. The research on this is clear. Time in the market beats timing the market. Every single time. Studies comparing investors who invested immediately at market peaks versus investors who waited for the perfect moment. The immediate investors won almost every time over long periods. Because the cost of being wrong about timing is lower than the cost of waiting on the sidelines. The best time to start investing was 10 years ago. The second best time is right now. Fear number 4, not having enough money to start. This one used to be more valid than it is today. Old school brokerage accounts had minimum deposits of $1,000 or more. Today most major platforms have zero minimums. Fidelity, Schwab, M1 Finance, Robinhood, You can start with $1. Literally $1. And with fractional shares you can buy a piece of an index fund or even a single high-price stock for whatever amount you have available. This excuse no longer holds up. The amount matters less than the habit. Starting with $50 a month builds a habit that scales as income grows. The person who starts with $50 a month at 25 is in a dramatically better position at 45 than the person who waited until they had enough to make it worth it. Because the real value isn't the $50. It's the habit, the discipline, the compounding that starts on day one. So how do you actually start? Here's a dead simple first step framework. Step 1: open an account. If your job offers a 401k with employer matching, start there. Contribute at least enough to get the full match. That match is an instant 50% to 100% return on your money depending on your employer's plan. Nothing in investing guarantees that kind of immediate return. If no 401k or no match, open a Roth IRA. Fidelity and Schwab are excellent. Free to open. No minimums on most funds. Step 2: pick a simple investments. You don't need to research individual stocks. Pick a total market index fund or an S&P 500 index fund. At Fidelity, FZROX or FXAIX are solid. At Vanguard, VTI or VOO. At Schwab, SWTSX or SHB. These are diversified, low cost, proven over decades. Step 3: set up automatic contributions. Decide on an amount, even if it's $25 or $50 a month. Set it to auto-invest on the same day every month. Don't look at it constantly. Don't react to market news. Just let it run. Step 4: increase contributions as income grows. Every raise, direct a portion into investments before lifestyle creep absorbs it. Even 1% more per year makes a massive difference over 20 years. That's the whole system. Not complicated. Not requiring expertise. Not requiring a large starting amount. Just a decision, an account, and an automatic habit. The fear of investing is understandable, but the cost of that fear is real. Every month on the sidelines is a month of compounding that doesn't happen. A month the market moves without you. A month closer to retirement without the growth you needed. Fear keeps people safe in the short term. It keeps people poor in the long term. The answer isn't to eliminate the fear. It's to take the first step anyway, with a simple, diversified approach that doesn't require you to be an expert. Because you don't need to be an expert. You just need to start. Hit like if this pushed you one step closer. Subscribe for the whole series. And drop a comment. What's been holding you back from investing? Let's talk about it. The best investment you'll ever make is the one you actually start. See you in the next one.